Hi, I'm Bobbie Goldie, and welcome to What's Brewing, where we discuss emerging trends in the insurance industry and IAT services and product offerings. After you leave this webinar, you'll see a survey pop up in your browser. Please take a couple minutes to answer this. It'll be real short, and you can actually tell us what you want to hear more about. Today's guest is the EVP of Excess and Surplus, Coy Rudd. Coy joined IAT in 2017 with more than 30 years experience in the E&S industry. So Coy, thank you for joining us today.
Thank you for having me.
Before we get into the weeds, I'd love you just to walk through what E&S products your group does.
Sure. The E&S business unit has three distinct product lines. We have primary casualty, we have excess casualty, and we have contract binding.
All right. So in that space, one of the things that I continue to hear is about new carriers coming out and all of this new capacity. How does that impact the market?
Sure. So over the course of the last 2 years, I would say, maybe even slightly longer, maybe 30 months, there have been a number of new MGAs, MGUs, and even new insurance carriers that have surfaced. So these new entrants were on the drawing board over the last 4 years or so. They've come into the market with surplus lines capacity or excess and surplus lines, which gives them an easier way to get into the market because of the freedom of rate and form. And now they're up and operational for the past 12 to 18 months. And those markets have increased the level of competition, which has, of course, given the buyer more choices and enable the buyers, particularly the more discriminating buyers who have good risk management and good loss histories, to benefit in a lower cost product.
So what I see is a couple things. I see that it's obviously exactly what you said. First and foremost, they're going to get a product that's priced better. A couple things I see is agents have more work, brokers having more work because there's a lot of competition out there. So the agents and brokers are really going to have to do some due diligence along with the insurance.
Correct.
Right? Because it's not just about
price. Absolutely.
So what are some of the things that they should be looking at?
Sure. So they should be looking at the security level, right? Are they AM Best rated? And then where within AM Best are they rated? Are they A plus? Are they A or A minus? And what the security level is, meaning is it a 10, 11, or 12, right? Mm-hmm. The stronger the number or the higher the number, the better capitalized that particular paper is, if you will. So the financial security is first and foremost.
Yes.
Then behind that is what product are they offering? Is there any differentiation in coverage? Is there more coverage? Are there more restrictive terms? Mm-hmm. So you want to certainly pay attention to the terms and conditions that are being offered in comparison to what the established markets, like even ourselves at IAT and in excess casualty E&S, we've been around for almost 5 years in a couple of months. So not only is it price, is it security, it's the product in and of itself as far as terms and conditions, et cetera. And then there's the service level. How quickly are you getting a quote? Are there enough people to man that business, if you will? Are they geographic in spread, or are they centrally located? Are you closer to the customer or not? All of those things go into the buyer having to make a choice now from what was, let's just say 50 markets to now 80 markets.
Oh my goodness.
My understanding is that just in the excess casualty space over the last 24 to 36 months, 25 to 30 new entrants have made their way between MGAs, MGUs, and carriers.
Wow.
So
That is disruption.
gives the buyers a lot to think about and a lot of things to compare. But our service, our knowledge are all things that help make us competitive in this space.
So Coy, outside of capacity, what are some of the things agents should watch out for in this marketplace?
Sure. Some of the other contributing factors to the current marketplace are the pace of litigation is starting to pick back up as the courts reopen in the post-COVID world. So you're going to see more trials get on the docket, more settlements taking place, more mediation. So there's going to be more activity from the claim side because courts are back open. Then there's inflation, and there's two types of inflation that is definitely affecting the insurance industry. There's the economic and price inflation, so the price of building materials, the cost of food and goods and services has gone up, and so too has the cost of our product, right? Because if we don't keep up with the pace of inflation, then we're basically, eroding our premium volume because of the increased cost of goods and services. And then there's social inflation, and that's just the sentiment of individuals and jurors and juries and pricing cases, and those cases are worth more now, right? I call it a little bit of the lottery mentality. People start with, $1 million or millions of dollars for settlements and ultimately verdicts when those cases go that far. So between economic inflation and social inflation, there is definitely an effect on carriers in terms of their pricing, their terms and conditions, and their willingness to just participate in this particular segment of the market.
Because of the courts getting back to session and dealing with social inflation as well as economic inflation, but on the opposite side, because these verdicts are so high, how are they managing both sides of that?
Sure. So again, to harken back to the good risks and the discriminating buyer, because the price of the product generally has kind of stabilized in some instances because of more competition, they're actually able to buy more capacity, right? So if they have bigger assets, bigger balance sheet, and the price of the product's affordability is enhanced, they can buy more capacity. For those that have not as good risk management or tougher loss experience, and the price of the product being higher for those customers, then they tend to buy as much as they legally need, right?
Wow.
So an example would be a contracting firm that's, putting up new buildings. If the state requires 10 million in capacity, then that particular contractor is only going to buy the 10 that they need to legally conduct their work.
Okay.
So better risk, better opportunity to buy more capacity, tougher risk, tougher loss experience. They're going to buy just what they can afford and what they legally need to keep the doors open for their business.
Okay. What about Gulf State property? I feel like we've hit this point in time where the Gulf seems to be where all the natural disasters are hitting.
Well, all the action is happening. So over the course of the last, I'll just say, 4 or 5 year window, there's been a lot of storm activity, right? The named storms that is costing the industry. The availability of capacity has shrunk as carriers become more and more conservative, and they're willing to participate, particularly in that Gulf, and then how much capacity they're willing to put out, which has had the effect of increasing pricing for those that are willing to even participate in that space. And that market has gotten smaller and smaller in terms of writing business down there because of the propensity to have pretty big storms and expensive storms. Yeah. But for those that remain in the space, it's a firm space from a rate perspective. The amount of capacity being offered has shrunk, and so the buyers are getting less for their dollar, if you will. But the nature of what's transpired over the last 4 or 5 years in that geographic zone has naturally pushed the insurance industry to a more conservative position as far as providing the coverage. But there are still plenty of carriers out there but it's definitely a lot smaller participants, a lot fewer participants than there were 5, 8 years ago.
Yeah, I feel like I've noticed Texas have major freezes like every couple of years now. I'm like, is this just going to be standard practice now? We're going to see a freeze in Texas every few years?
Well, I not being one that can predict the weather, but I mean, certainly they were vulnerable to that when that happened back in February of, I believe it was 21. And so we just have to, continue to watch the weather patterns as they develop and govern, on the basis of that.
Yeah.
But by and large, there's still plenty of carriers offering protection, particularly property protection, but certainly the price has gone up.
All right, lastly, talking about some of the things that are going on in the industry that you're managing through, what about the discriminant buyer?
So the discriminant buyer, as we spoke about earlier, has much bigger choices in terms of primary and excess casualty are concerned. But that buyer has learned the effect of having a good risk management program and a safety program, and those pay dividends in the claims frequency going down. So they get a better price product, which enables them to buy more capacity and gives them more bang for their buck, if you will.
Okay. So right now, that's where you want to be in the marketplace.
Yeah, as a buyer, that's certainly the position you'd like to be in. We happen to write business across a spectrum of buyers, right? Yeah. So you have your blue chip buyer, if you will, who has the best of risk management, the best of safety, but we're the surplus lines industry. We also get the buyer that's not as advanced or sophisticated, and so their loss experience may be tougher. We write the tougher risks just by the very nature of what they are, right? Construction in tough venues, product manufacturers that are tougher products, right? Machinery products, et cetera. So we also have to have a product and coverage available to that segment of the market. That's what the E&S segment started out as and continues to be. The surplus lines industry and the surplus lines segment of the industry has grown significantly over the last 5 years. When I came to IAT in 2017, the surplus lines space was defined as about a $40 to $42 billion space. Currently, I think the 2022, the surplus lines segment finished at just about $80 billion.
It doubled.
The surplus lines market has doubled in a little over 5 years.
Wow.
So there's quite a bit of growth in it, which enables this growth in carriers and new competitors. But it's kept up because the customers have come to the surplus lines as a space where they can get tailored coverage, a customized product to fit their insurance needs.
All right, that's good to know. So that brings us right into my next question.
Sure.
About your appetite. And where would you, so let's talk about your appetite, but then let's also talk about where you'd like to expand your footprint.
Sure. So our appetite is a pretty mainstream, if you will, surplus lines appetite. What does that mean? So we cover contractors. We look for the tougher product manufacturers. We do some auto-driven business, things like moving and storage or distributors. We do premises risk, commercial premises. We do habitational risk. We do some public entities, some public sector risk. So the things that flow and find their way into the surplus line space generally is what we have as part of our risk appetite. Where we'd like to grow our geographic footprint is in places like the Midwest, where there's a lot of machinery manufacturing and still going on. Some of the West Coast and Southwest, we'd like to expand our geographic footprint. We're a national company and we have offices spread throughout the country, but we want to write more business in the Midwest and some of the Southwest to help balance our portfolio out, which is a little bit Southeast and Northeast centric, if you will. There is penetration in the Midwest, but we'd like to get more penetration there.
You continue to say E&S, so does that mean you're wholesale only?
We are wholesale dedicated. let me repeat myself. We're wholesale dedicated. No, we have a clientele that is dedicated to the wholesaler.
Yeah.
And we look to expand our footprint with our existing customers. So you might say, well, how do you do that? Well, we work with national wholesalers as well as regional and local wholesalers.
Okay.
And some of the larger regional and national wholesalers have offices throughout the country. And so where we may have, let's just say one organization we're open with 10 offices, we'd like to try to increase that over time to maybe part of their organization out west, and where they may have 3 or 4 or 5 offices. So we're looking to expand the footprint with our existing customer base.
Okay.
And then if there are new or other wholesalers we're not currently trading with, and we have a match in terms of our risk appetite and the business that comes in their door, well, we're open to expanding the footprint within those wholesalers we're not currently doing business with. But as far as the surplus lines business unit is concerned, our only customer is and will continue to be the wholesaler.
So with a national footprint and very strong relationships, if I were an agent listening to this webinar and I had some more of that difficult to place type exposure out there, somebody could reach out to anybody in your group within IAT and they could connect that retailer with one of your partner wholesalers?
Yeah, our wholesalers can reach out to us and reach any of our underwriters that are across the country, depending upon where that wholesaler is. So we're set up with a footprint that has offices in the far west, in the southeast, in the Midwest, and in the Northeast. And we look to match our underwriters up to the geographic region. We like our underwriter closer to the customer, right? And that allows us to transact business that has a regional focus on it, if you will. I've always been a proponent of the underwriter understanding his geographic region and the culture of that region. It makes a lot of sense for somebody who's writing contracting in the state of New York to be either in New York or New Jersey or Pennsylvania, where they can really understand the nuances of, the law that applies in that state. Same for the West. It only makes sense for somebody who's writing business out west to be seated out west and be closer to the wholesaler and ultimately closer to the customer, and they understand the culture and the nuances of that particular geographic region.
And that's such a benefit for, not only your underwriters, but your partners as well as the clients, because you're able to provide that value add because you know what's going on in that geographical region.
Yeah, you understand that region, you understand the culture, you can meet with the wholesaler, you can meet with the client face to face. We do a lot of work, obviously through mechanization, but that local presence, we also work to get out and meet our wholesalers, and when requested, we'll meet with the clients as well. If they want a meeting to talk about their exposures and the coverages we can provide, we're more than willing to do that.
Nice, nice. So let's talk about a couple of your recent successes.
Sure. So we have 3 different product lines. In our primary casualty area, we were fortunate enough to retain a recent large habitational account. This account is unique because it's set up with a large self-insured retention, and then we provide limits, primary casualty limits right over the top of that, and there were no less than half a dozen carriers bidding on that business. But I can tell you it was the relationship with the underwriter and the underwriting manager, as well as the service and the coverage provided that IAT has consistently provided for the past 4 years, that ultimately won the day. And even though we may not have necessarily been the cheapest price out there, the service, the coverage, and the relationship went a long way in retaining that particular account.
Nice.
It's actually the largest account in the primary casualty portfolio.
Nice.
There was another recent experience on an excess casualty account that had been a long-term account. And when I say long-term for E&S, if you keep a risk in the 4 or 5 year window, that's a pretty long time, because there's a lot of competition and it's price sensitive in terms and conditions. And we were able to kind of change the program that we offered from last year to this year that allowed the buyer to get comfortable with the coverage we were providing at the price we were able to provide it at. and kept us on that placement. You know, with excess, you can be attaching anywhere in a tower that could be from the first million up to, let's just say, for example, the 25th million. The year prior, we attached at one level. The next year, we ended up attaching at a little bit higher level. But we were able to retain that account, a place on the account, and we actually reduced the limit that we offered, but of course a price reduction was commensurate with that.
Yes.
But that helped enable the buyer to finish and build their tower above us. So that was a success, and again, it was a 5-year account, so it was a nice tailored solution, and again, the relationship went a very long way in keeping us on that placement.
Very cool.
And then in our contract binding area,
Yep.
the team and the support around it, IT and what have you, we've worked pretty diligently to respond to the changing and challenging Gulf Coast property market that we talked about earlier. So we've enhanced a lot of things in terms of our operation, in terms of service and coverage, and obviously working on pricing to make sure we match up the price to the exposure and the buyer. So there have been a lot of enhancements that have been made over the last 4 or 5 months that will allow us to respond quicker in that space, but keep up with our peers in terms of the coverage being offered and the level of pricing and capacity that that market has, pivoted towards.
Okay, so you're in that market.
We're in that space. We have a set playbook with a defined appetite and defined limits on how much of that we want to write because we want a balanced portfolio.
Of course.
But we are a participant in that space.
All right, that's good to know. That's very good to know. So what sets you apart or your team apart from your competition? I know you and I spoke on a different stage a year ago, and I was just in awe of what you and your team have done on the excess side, especially in a market where there is a lot of capacity, in what you've done in primary and even all the adjustments in contract binding.
Sure.
How are you guys so successful?
Well, I will tell you, I was just going to say, it's not limited to the excess folks. What I've been fortunate enough to observe and have as a working team are all 3 segments enjoy strong relationships, and they enjoy long tenured relationships. Lots of those started before they came to IAT and followed the underwriting team to IAT. So whether it's contract binding, primary casualty, or excess casualty, those are relationships that have been built in some cases over a better than 20-year period. And some are shorter, obviously. But the level of service, the level of trust that the customer places in that relationship because they know that underwriter or underwriting team will deliver on what they said they can deliver. You may have recall me saying, we can't always say yes.
Yes.
Sometimes we have to say this one doesn't fit, but when we can say yes, we run to the yes. And that's getting to the customer quickly, providing what you said you could provide in the manner that you said you could provide it. And I think that helps sets us apart in addition to the blocking and tackling that IAT provides. Good security, good systems, good service, right? We have claims, we have loss control. All of those go into contributing to the ultimate end product, the promise to pay, memorialized in a policy that we provide our customers.
And you mentioned that a lot of these relationships have been created or strengthened over several years. So tenure. What's like the average tenure of your team? Because that's a lot of expertise.
Sure. So I would say in the excess casualty, it's probably average tenure north of 15 years.
Oh, wow.
I would say in the industry.
Yeah.
I would say in the primary casualty, it's probably somewhere between 10 and 15. And then the contract binding, we have a young, energetic team.
Yeah.
And so it's probably more on the order of 5 to 10 or 12 years.
Still pretty amazing.
All good, solid, tenures in the business, all with good relationships. And I watch our different teams and participate with them in different events. and the camaraderie that's enjoyed between the team and then the team and their customer, the wholesaler. It's really nice to watch. It brings a smile to my face as I watch the teams interact with their customers.
I love it. I love it. And that, again, just think of all the expertise year over year and what they've seen come across their desk.
Yeah, it's an interesting and fun industry, and this segment of it, the excess and surplus lines, adds even more variety to that.
Well, thank you so much for joining me today, Coy. It was a pleasure speaking to you again. And as always, it's fun to watch your team grow and make a name for IAT in this space.
Well, thank you for having me, and we enjoy talking about the excess and surplus business and obviously representing IAT.
Thank you. And thank you for joining me today. As I mentioned at the beginning of the webinar, a survey will pop up in your browser. Please just take a couple minutes to provide your feedback so we can make sure in the future we're sharing what you want to hear about. I'm Bobbie Goldie with What's Brewing. We'll see you next time.